following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. I call it old, but it really isn't that old, Don. It's actually, I guess from internet time it is, because we did our show, Options Insider Radio, that kind of kicked off the network. Is really, to my knowledge, the first and longest running options podcast online. So I guess from that perspective, it's an old network. But of course, this is the show where we dive into all of the interesting elements of volatility and volatility trading. And joining me on the program today is none other than the major domo over there at the Volatility Exchange, the yin to my yang, the premium seller extraordinaire himself. Good old better. Don Schlesinger from Volex. Don, welcome back to the show.
Thank you very much. Happy to be here. Looking forward to our guest, one of many who will be coming in the next few weeks.
Yes, it should be an interesting show today. We will be joined a little later by good old Mark Sebastian. And then, of course, we will have, as we promised on our recent episodes, our string of guests continues today with Jeff Lewandowski, and that should be an interesting segment as well. But I think with that, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review, and this is, of course, where we look back on the week's worth of action from a volatility perspective, and we actually had to move the show up one day this week, so we're recording a little bit early, so we won't get the full gamut of volatility action. And actually, this week, that would be nice because we are recording right a couple hours before some of the big names announced their earnings. Of course, Amazon and Apple and a few others, and particularly in Don's neck of the woods these days, NASDAQ, vol. Those are some key drivers. So we'll be able to have to talk about those on next week's show. But I know a lot of people are amped and excited and or biting their fingernails going into today's big announcements. Apple, of course, not exactly faring too well. They had, I guess you can call it a mini earnings announcement earlier this week when they announced their new products. And the stock not exactly living up to some of the hype, taking quite a beating, down about another percent almost today, or nearly 6 handles, to about trading about 611 as we're recording this right now. So, Don, I think we'll start there. It's been an interesting week from a NASDAQ vol perspective. What in particular has caught your eye over the past few days?
Well, of course, not only NASDAQ, but all the major equity indices in general. And I think that when we put up last week's show and we talked about the crystal ball, the little blurb to summarize our findings at the end of last week's show was look for an uptick in volatility, but we'll have to look to earnings. And I remember saying on the show, not having the slightest idea what those earnings would be, that this concept of looking at VIX or even at realized volatility and predicting the direction is very much tied, as always, to market direction itself. So we all know that this has been a rather rocky week with some market movement that had the biggest drops in the indices since the middle of June, which was certainly the case for both NASDAQ and the S&P. And as a result, you did have the expected increase in both realized and implied volatility. So I think the NASDAQ realized trailing 21-day historical was in the mid 12 handle last time we spoke, and we're now looking at 15.3. So both in actual percentage points and as a percentage of 12, this is a rather large increase and bump up. And as you all heard from Mark with his comments, correspondingly a similar type of increase in VIX and in S&P realized volatility.
Yes, it's interesting. We always talk about that implied risk premium. I know you love to talk about it here, Don. It's one of your favorite topics. And typically it runs about 4% or so,
yeah, on a long-term annualized type of basis, it is very much in that 3 to 4, 3.5% range. And we've often spoken about how that spread gets distorted one way or the other. But once again, here we're kind of looking at the upper range, at least in S&P, with about 11.5 for the trailing realized volatility, and VIX as we speak now in the mid 18s. So that spread certainly is somewhat larger. Again, recognize that there is this mismatch in time. We're looking backwards at realized volatility. We're looking forwards for VIX, and so you'd want to kind of match those up so there wouldn't be that kind of lag or that leading type of indicator, so you're not comparing apples to oranges. But nonetheless, looking back at historical and looking forward at implied, you're seeing a spread here that's somewhat on the high side.
Now, Don, I know, speaking of historical, you're historically inclined against buying any sort of volatility. But I'd imagine, I know you guys are working over there at Volex diligently to get those realized NASDAQ vol contracts out. And I would imagine that you wouldn't have much problem with someone coming out, and perhaps even you, and writing the implied vol and then buying your NASDAQ vol product to try to lock in that differential. So in your mind, is that an improved instance of buying volatility because it is pure realized, or do you hold your nose up even at that, sir?
Well, here's the part that's interesting, and it's part of this paper that Nick Lee discussed, and I hope our listeners heard in last week's show. If not, it's already up on the site, so please give a listen to some of these findings. The whole concept of potentially spreading a VIX implied product with a realized product has many interesting possibilities, and it will only be a very short time before we make that paper available on the website. But to answer your question, here again, as you get into the pure realized volatility calculation period for a volatility contract, and you have the potential to spread that against an implied volatility contract, there will definitely be times when this spread is distended or distorted. And that's the kind of time where, as you say, rather than just pure go out and buy volatility, which is not my cup of tea, doing it as a spread where you have a sell component also is something that I think would be very attractive to me, where I'm selling the implied, buying the realized, and simply making a bet that spread will narrow, as opposed to making a one-sided bet as to whether a side will go up or down all by itself.
That's true. It's not really a pure vol buy straight up, because you have the spread component to it. But I just thought I would lure you to the light side any way that I could, and see if perhaps you would be tempted by that. And it sounds like...
Yeah, I'll admit to being able to say the words buy the vol contract, as long as very fast after it I said sell. I'd probably sell first, knowing me.
See, you are a vol buyer. You're just waiting for the right product to come along, and you had to make it yourself. And then, of course, you will be a diligent buyer of volatility going forward, I would imagine.
The way I would normally do these kinds of spreads would be, sell and then stick around and wait to see if there was a good time to buy, and then probably wind up saying, let's just leave it with the sell side.
All right, and we also cover the full spectrum of volatility here on the show, and that includes, of course, S&P 500 vol, a.k.a. the VIX. And so we'll turn, as always, to our good friend Mark Sebastian from Option Pit to fill us in on what he's been watching over the past week in S&P 500 volatility. Take it away, Mark.
Well, it's been earnings, but it's been kind of interesting. Here we are. This has been a pretty rough week for the S&Ps, and yet, we're off. Vol has barely moved. We had a nice pop on Friday, but we haven't really done a lot since then. We got a little extra kick on Monday, but there hasn't been much carry through out of from the VIX beyond that. We're actually, despite yesterday we were being down, the VIX was down, and we're up a touch today, and the VIX is down. To be honest, I think that a lot of people are looking at this Apple earnings and really getting prepped for that.
Yeah, the big number is coming tonight.
People are paying attention to that. I liken it to there's a group of people that are realistic, and I know for a fact that there is a group of people that are kind of like gymnasts holding hands, waiting for the final score from a pole vault or from a vault to come in.
Did you just use realistic and Apple in the same sentence? I don't think those two words really go together.
Yeah.
Sir.
No, I mean it is ridiculous, but it's like. I envision the girls' gymnastics team waiting for a score, holding each other's hands ahead of this report.
We're going to be talking to Jeff Lewandowski a little bit later about commodity vol skew. One of the few places you can find anything approaching commodity skew on the upside, at least over the last few months, has been Apple, and certainly leading up into earnings.
Apple, and then commodities and VIX. But that's it. Yeah, Apple skew actually converted into a lot more of what we would have seen in like 2000 and 1999, where for a period of time where actually calls got more expensive than puts, and the skew converted, which was a clear sign of euphoria and a near top in the market.
I think euphoria is a charitable term. Euphoria.
Let's just say irrational,
exuberance, madness. Insert your own preferred term there. I like that, euphoria. How charitable of you, sir. Uncharacteristically charitable, I should say.
I know.
So, yes, an interesting one. We are recording, of course, a little bit earlier this week, so we won't be able to talk about the Apple earnings, but we'll talk about them next week.
One thing I'd point out on Apple that's actually interesting is that right now the spread between Dec and Jan, which are the back months, is very favorable for a time spread. And that actually looks like if I was going to play Apple earnings, I would actually probably do it in the form of I'd probably completely ignore the November contracts and play something in Dec Jan. So
Dec Jan, there you go. We heard it here first, listeners. All right, thank you for that, Mark. And now with that, we're going to close out our volatility review segment and dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky music means it's time once again for the Volatility Viewpoint segment. This is the portion of the show where Don and I welcome a guest onto the program, and today's guest should be really interesting because he's going to touch on a subject that we've only really briefly discussed here on the program, and we've wanted to get into in more detail for quite a while, and so he is going to help us do that. He is Jeff Lewandowski with Foremost Trading, and Jeff is, let's just say, well-versed in the dark arts of commodity and futures options trading. Jeff, welcome to the program.
Thank you, Mark, and thanks for that real bright introduction. I appreciate it. And Don, thanks for having me. I do look forward to today because I think there's lots of opportunities in trading options in the futures world, but a lot of people are inhibited because of what I call the comfort level at many angles, whether it be the underlying product, the crazy price schemes we have of the product, of the underlying products, and that's why I enjoy helping people better understand them. You can still make your own decisions of which way you think the underlying's going, but having a good understanding of the nature of the product, or as I like to say, trading futures is like going to the zoo, and every different sector is like a different part of the zoo. And once you approach it that way, I think you can have a lot more success versus the equity field, which to me is more of a template based on a few known denominators such as price earnings ratios and things like that. So that's what got me more enthused to leave the CBOE and get into the futures world.
Let's talk about that for a second then. We like to do this with all of our guests, give them a chance to, especially when they're first on the program, to give them a chance to explain to our listeners a little bit of an overview of their background in the options and derivative space. So why don't you do that, Jeff, and give our listeners a little bit of a rundown of your history here in the land of options and futures.
All right. I started out of college as a runner because in 1982, when I graduated, the unemployment rate was very similar to as it was now. I had a degree in finance with a strong computer background and a strong accounting background. That being said, there wasn't a lot of opportunities, and I had an opportunity to be a runner on the floor, and it worked out well for me. I fell in love with the concepts of the whole open market, and knew very little about options. And as we probably teach at the beginner level, or as I teach at the beginner level, the learning curve in options is very, very flat at first, but if you do put your time into it, it's very similar to the risk-reward analysis of a call. Meaning, if you look at the left side, you have your loss, and the flat line moves to the right, and then as you go up in price, your profit increases, and that's what happens. Hopefully, you guys can envision this. You've seen enough of these. That's how I teach option education, and the key is, if you do stick with it, you're going to catch on. The other key to teaching people about options these days is we have tremendous tools that help people better understand with a visual concept versus in the old days when we had to just do profit and loss on paper and then kind of figure it out in our head. So, but I was on the floor until about 2000. At that point, my ears had enough, and I decided to leave, and I transitioned into the wonderful world of what we used to call upstairs trading, which is now known more as electronic trading. And at that point, options really hadn't caught on the electronic platforms. So I migrated away from stocks and got interested in futures because technical analysis was something I became more enthused with. The different sectors and the fundamentals of those sectors and the seasonality of the different types of sectors. And then as options came back in, say 10 years ago, from a transparency standpoint to the electronic traders, I got more involved again, and that in a nutshell is what brings me here today.
Now, Jeff, you mentioned calls and the performance of a call. I think that's a good segue into, I think, one of the more interesting topics from our perspective here on Volatility Views when we're talking about commodities, and that is, of course, commodity volatility skew. We've touched on skew myriad times here on the program, always really focusing primarily on investment skew because that's what most of the products we deal with trade in. That, of course, is the shape of the skew where the calls have a decreased level of implied volatility that puts our bid up. So you have that kind of characteristic shape for most equity and index options. Of course, as we've touched on only briefly on the show, commodities are an entirely different ballgame. They don't have the same skew at all. They have actually that upside premium because a lot of the fear and uncertainty in commodity land comes from the upside. So it's an interesting shape. So why don't you walk our listeners through some of that basic reasoning behind commodity skew and why it is shaped that way. Of course, there's many different variations on commodity skew depending on the product, but the basic commodity skew, and then we'll get into some of the different ways that some strategies people might be familiar with on the equity option side, how they perform perhaps a little bit differently on the commodity side.
Correct. And this is something, hopefully, Mark, we can keep at a level that approaches most of your audience, because one thing about the world of options is it's three-dimensional, and volatility is one of those dimensions, and the skews are components within there. So I will try to keep it at a level that we can listen to and understand.
Yeah, sometimes it's hard to paint that picture with your words. Such is the challenge of audio.
Yes. But if they can do golf on the radio, we can do option education.
I never thought of it that way, but it's worked for us for about 5 years. I guess we're the golf of options radio.
I understand, but I have done this. But as I said, the learning platforms and trading platforms have helped as much in education as they have in risk analysis, which is good. Anyways, what is a skew? A skew is the shape of the volatility as it pertains to the as it moves away from the at the money options. So if you look at a skew, usually the middle of what you're looking at is the at the money option. As you move to the right, that represents higher prices or the out of the money calls. It also represents the pricing of the in the money puts. Most people tend to trade very few in the money options. I'm not saying people don't trade them. Some people are very good at trading them, but the majority of traders trade out of the money calls, and for the same point, they trade out of the money puts, whether they like to sell them or buy them, taking their lottery type shots. So if you look at a skew graph again, the center's your at the money. The right side would be the out of the money calls, and to the left would be your out of the money puts. Your equity traders are probably familiar with the fact that the skew of an equity product normally, under most situations, tends to be negative. That means that the pricing, the slope of that is a 45-degree angle, roughly, with higher on the left side, lower on the right side, meaning the volatility that's implied in the skew measures traditionally implied volatility. And the out of the money puts tend to have a higher volatility, as we all know, and talking about the VIX, as the price of equities goes down, the VIX goes up, and that's true also reflected in the skew of an equity. So if you can vision a 45-degree slope, that is a traditional negative skew. Now, there are some products on the future side in some commodities that have traditional negative skews as well. For example, most of your energy stocks have traditional negative skews, believe it or not, when you would think it would be a supply type product, as Mark alluded to before, and I'll talk about that as we get into the grains later in brief. But I was always surprised when I learned that, and the reason being, the demand for crude is usually associated with the economic strength. And as the economy goes down, so does the price of crude. So does the price of crude, and the volatility increases. So learning these relationships are not hard. There's great resources to learn them. But I think having an understanding of the different skew structure can help you as we maybe get a little forward. And again, you can probably see there's a lot to this for one show. But at the same time, I'm trying to give an overview so that we can then maybe in future shows or later today talk about basic spread strategy around these skews. So if we look at the skew structure of a negative skew, we can talk about our equities, and we can also look at some of the common skew structures of the energies. Now, that being said, and without confusing you, sometimes the skew structure of crude oil can also get inflated on the upside and cause what's called a smiley skew, especially when there's uncertainty of political unrest or something in the Middle East.
Like that day of rage a couple of years ago when people were loading up on the 200 strike out there in crude.
Exactly. And let's talk about what causes volatility, implied volatility, to increase in options. It's basically supply versus demand, or fear, or lack of fear. It's a battle between the buyers and the sellers. It's where they agree on price. And when the buyers are more aggressive and think there's a greater chance of the risk of that happening, they're willing to pay a higher premium. At the same time, when the sellers believe that, they want to take a higher premium to offset their potential risk. So when you do have those 1 or 2 day flare-ups or weak flare-ups in crude, you can see that skew change. And that's what's unique to commodity options is if you go back and look at some skews 6 months ago in some products, they could have a totally different shape from what they do now based on the fundamentals of what's happening. So that's your basic negative skew. The next most common skew would be a positive skew. Mark alluded to that, and those are usually associated with end user type products like your grains, your agricultural products, because as the price of those products goes up, as I say, there's more pain to the end user, whether it be someone who has to deliver that product or someone who has to use it in some other way, and a negative price affects them. A higher price affects them negatively, so they tend to hedge by maybe buying a call option to protect themselves against higher price movement. So your grains tend to have a positive skew. However, that being said, and looking through my little charts that show me skews and volatility levels, I noticed that within corn and wheat, we have a pretty much positive skew. Which again would be a 45-degree line that slants up to the right from lower in the left upper, higher in the right. And but soybeans, however, have developed a negative skew, and that's new only in the last month and a half. The reason I think for that is we've had a 17 or 18% move in the last 30 days in soybeans to the downside. So that kind of probably was a surprise to traders, especially since corn and wheat haven't really played along in that game per se. And some of these people that were short, maybe those out of the monies, were forced to be more aggressive in buying them back, whether it be for margin reasons or just to cover risk. So
that just goes to show what I was talking about, that, I say commodity skew, but I use that term very loosely because there are so many different skews under that rubric of commodity skews, and every product seems to have its own unique characteristics therein. So you can't just say, all commodities are extremely bid up to the upside and vice versa, because it doesn't work out that way.
Exactly. And that's why I tend to tell people when they're new to the futures world, don't jump around because gold just moved $30 or $40 the previous day. Be sure you learn that product because trading options in those products, having 3 dimensions and with skew risk, can become very apparent. Before I go on any further, Mark, I want to ask you: do you think that I'm at a level that I'm confusing you, or are you picking up what I'm putting down?
No. I think the bulk of our listeners here on this show are fairly sophisticated. So I think you could easily aim over their heads, and the bulk of them will be able to follow along with you. And the ones who aren't, they'll be encouraged to learn. So I think we always encourage our guests to aim a little high here on these programs. So feel free, sir, to carry on.
All right. And also, when you're talking about commodities and skews, we look at the very outsides. Those, as we know, are the dreaded fat tails. I tend to see those more exaggerated, or have seen those much more exaggerated in commodity type products, probably for 2 reasons. One, I think there's higher volatility inherent in a lot of these products, such as your energies and your metals and things like that when they really get moving. And secondly, volume. And there's not always enough volume to handle the what's needed in some of those out of the money options. So just a word of caution. I know a lot of people like to jump into these. When you're looking at volatility options and stuff, always try to look to the strike prices that have the most open interest and volume. And they're pretty obvious, so we don't really need to go into that. But as much as I like to help people, I like to caution them as well, because there are some great plays in future options. Because we do have such tremendous movement in some of these products.
Now you talked about jumping in. I don't mean to derail you, Jeff, but you talked about jumping in. Let's hit on that for a second, because one of the most frequent questions we receive over here at the Options Insider has to do with that, and people coming from the equity option side of the fence into the futures options realm, and they're learning about commodity products, and they're trying to apply their traditional strategies to their new products. And of course, one of everyone's favorite equity option strategies is the covered call. And what we've seen on the equity option side is people migrating their liquidity farther and farther down to the at-the-money strike, or even in many cases to the in-the-money strikes, because there simply is no premium left on the upside call wing in any equity option. It's pretty much been depressed. Unless you're trading Apple around earnings, there really isn't much bump to the upside in most names anymore. Whereas a lot of people, when they're coming to these commodities now and they're experiencing that positive skew that you discussed, it's a bit of a revelation. It's a bit of an awakening for them that they're actually being rewarded again for riding upside, and actually a fairly healthy amount too. That must be, I think, a big eye opener for a lot of the people who come to you for the first time, that they can actually do this strategy, which a much higher probability of a quality payout on the commodity side.
If you look back at January and February in gold, when there was another big talk of an up move, the out-of-the-money calls were trading at such a high value that just basic covered calls alone were offering tremendous returns, even if you were called away on your underlying. And I said this is just because you were looking at volatility levels that were in the 40s and 50s, and very rarely do you see that in equities, but that's not uncommon in commodities to see levels get that, especially in your energy stocks, energy futures, and in your metals. And then just the basic covered calls become very attractive alone versus, which is to me is a no-brainer because you have an upside bias. Now you always want to make sure that you're looking to the fact that there's risk to the downside with covered calls, as you probably point out often, but you get such a juicy premium where you do against versus the equities, which those far out of the money calls are even less than where the VIX is, right?
Yeah, so I mean, if you're one of these equity traders and you're equity option traders and you're the ones writing to us all the time lamenting the lack of premium out there, I think, that's why so many people have been jumping to the dark side of commodities over the past year or two, because they're finding those premium levels and those trades are much more viable on that side of the fence, at least right now.
Yeah,
Jeff,
they're viable,
if I could
they're fun.
Jeff, if I could jump in with a question for just a minute and to backtrack a little bit in understanding everything that you've said, we kind of set up a scenario where, whichever side causes the most pain to the end user, that's where the demand is, and that's what drives up the implied volatilities. So I guess the part that I did not understand was at the very beginning, and what you said actually was somewhat of a surprise to you. It's actually still a surprise to me, and that is from the end user's point of view of oil or crude or putting gas in our tank, the pain is caused to the upside. So I guess I'm not quite following why there would be the negative skew that you indicated instead of what I would have expected to be as some of the other commodities and the positive one.
Well, I agree with you on that, and here's how I would answer that. And again, this is my opinion and not to be taken wholly, but as why it had a negative skew is because it's associated with a downturn in the economy, which is going to be lesser demand because people don't have the money. But as the price goes up, we never seem to see BP Amoco have lesser profits because they are very capable of passing those added expenses through to you. So I would say that's why it's not as an end user. And I don't think that there's many guys out there, even if they have a full fleet of BMWs and Mercedes toys, that go and buy some calls in case in case gas was to go back to the $4 or $5 area. So I don't think that's an end user who's going to be necessarily using an option. But for an end user of any other product, whether it be a trucking company or something, they usually tend to be able to incorporate and pass those costs along. That's really how I justify that. And I agree with you, Don. I would think it would be, if nothing else, more of a smile type skew where there's exposure to both sides and both people want to hedge. But I found that really the only time you see the smile skew in crude is when you have political unrest that could cause delivery type problems and shortages.
It's interesting you mentioned the hedging for the BMW driver. I've toyed with that many times on this show. Everyone out there, for the most part, has a naked short position on these products, whether they're aware of them or not. So I think a lot more people should be doing that, should be looking at verticals and some other sort of product to hedge their exposure, perhaps not at these levels, but when gas is a little bit lower, because I think a lot of people then would have a lot less stress at the pump if they were hedging their outright naked short gas position on a regular basis.
Well, before other people beat me to that newsletter about that, like maybe a Mark Sebastian or somebody who's very creative, I should probably send that out to my clients, considering the fact that we have very low fuel prices right now. But after the election, and isn't it strange how fuel has moved down at the pump so quickly in the last 2 weeks for no reason? But we could definitely see it come back up after the election, I think. So you might want to consider that. Let's talk about if you guys are done, we'll talk about the last smile, or the last skew that I like to point out to people, which is the smile skew, which is both ends are inflated. A lot of people I talk to have different reasons for why you'll see this, whether it be uncertainty of a move either way because of uncertainty or not. And you do see this in a lot of different products. Sometimes there'll be a smile and then it'll go flat again. A good example of this would be treasuries. The treasuries at times seem to have this formation. The currencies tend to have this skew at times, and you normally see this associated when you see a sideways pattern from a technical standpoint. And traders will believe that we're building up, and they think the market will move, but they're not quite sure which way. And that's why you'll see volatility build on the ends of these at the ends, whether it be out of the money calls or the out of the money puts. One thing I want to point out about skews is they do not predict future price movement. They just predict, I think, where people have concerns or fear. And I think Don brought that up too. I always use volatility as the fear factor, but in commodities, you can have a fear factor to the upside where you don't normally associate that with the equities. And that's what smiles represent to me, is just fear of the unknown to either way. And then sometimes those skews will actually go from flat to smiley. And anytime you have that happening, where you could take advantage of that and looking at different strategies would be your vertical type strategies, where you're buying nearer to the money options that are at a lesser volatility implied, and with the smile, the selling of the option with the higher implied volatility. And as that skew gets flatter, that alone can help profit your position. And sometimes you will see, especially doing ratios, you will see those wings get way up for a couple days, and then they'll come in. And it's not uncommon in things like crude or natural gas to see those wings move 3 or 4 or 5% at an implied level in a 1 or 2 day period. So I was going to talk a little about that later, but I'm going to see if you guys want to follow up with any questions.
So Jeff, you're hitting on some fantastic subjects, and I think a lot of us here could really go on about this for quite a while, because this is a subject that is very interesting to us, and we haven't really gotten into in any depths. I think that's a good place to cut it off for now, which is kind of just the basic primer on commodity volatility skew, something we've touched on many times on this show, but never to this degree of depth. And I think we'll let our listeners, let that gestate with them for a little bit. I think we'll look at bringing you back on down the road where we can get into some of these more specific strategies that you've laid out, because that's, I think, where the rubber meets the road for a lot of our listeners, being able to leg into these ratios, these verticals, how these different spreads that they're used to trading on the equity option side, how they really perform in a variety of these different ags with a variety of different skews, when they have the steep positive skew, when they actually have negative skew, when we're seeing smiles across the board. And how so many of these regular plain vanilla type strategies take on a whole new life in the commodity world. And of course, you have other things we haven't even touched on yet, limit up, limit down, how that impacts volatility and trading, a lot of things that people on the equity option side just have are not aware of at all. So I think there's a lot more we can dive into, and I think we could spend 3 shows on that. But rather than spend all that today, we'll save it and we'll bring you back on again. And just let our listeners know if they want to learn more about this stuff, or maybe contact you to ask some questions or learn more about what you're doing over there at Foremost Trading. How can people find out? How can people get a hold of you?
Sure, I'll give the shameless plug at the end. I want to thank you guys, and I agree with you. I could go all day, but I would even get confused at a certain point. And I want to thank Mark, you for having me on the show, and Don for letting me talk about anything that's related to options. And certainly volatility is fun, and skews are interesting. If you guys want to find out more or find out, I've put together a lot of stuff I can send you. The best way to contact me right now is Jeff, Jeff, at foremosttrading.com. I look forward to having the opportunity to come back, because you're right, Mark. There is a lot, and we've only talked about some things, but we've talked only now about vertical skews, and certainly there's the wide world of horizontal as well, which a lot of people probably use most in the equities with earnings types of events, and that happens a lot as well in the futures world with different reports that come out all the time.
And we should also tease, too, for our listeners that you're in the process of becoming a CTA. It's not finalized yet, so I can't call you a CTA yet, but you're in that process. So perhaps down the road, some of our listeners who want to explore these topics in more depth and perhaps talk to you about doing some of this stuff for them, they could reach out to you for that as well.
Absolutely, I appreciate that. We are in that hush or quiet period, and I'm hopeful that will be over sooner than later. But we're dealing with the wonderful NFA, and I love the NFA. If anybody's listening from the NFA, so.
All right, Jeff. Thanks for coming on, and we'll definitely have to bring you back on again on a future episode to explore these strategies in a little bit more depth for our listeners.
Great, thanks, guys.
All right, and that's going to do it for our Volatility Viewpoint segment, and now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and that haunting melody means it's time once again for the crystal ball. This is, of course, where we break down what we're looking at and what we're thinking for the coming week from a volatility perspective. And Don, we'll give you pride of place here and let you go first, since everyone's looking NASDAQ way these days with the big number tonight, numbers, I should say, the 2 A names announcing after the close today. What is your prognosis from a NASDAQ vol perspective?
Well, this is always a tough one, because you know that in front of earnings, as we've discussed many times, you very often do have, at least from an implied volatility standpoint, a jacking up of those implieds, and therefore when the event actually takes place, especially if it's in line and not a surprise, you actually see those implieds come in. It's very different, of course, when you speak about realized. You can't inflate a realized volatility prematurely, because it's a formula calculation, and you need the event to actually take place before you can actually observe whether volatility has gone up or down. So if there were to be any kind of earning surprise, it could very well not affect implied that much, which already has anticipated the event, but it could affect realized if there was any kind of a jump or a surprise either way to the upside or the downside, where the calculation itself of real or actual volatility would then factor in. So this is a kind of a tricky one. And when you talk about what's your prediction for volatility, you very much have to always specify, are you talking about realized or implied? Because in this type of a scenario, you can have 2 very different results, even from the same event.
Thank you for that, Don. Yes, it should be an interesting week and an interesting event to say the least. It's been a weird week just because we had that little blip earlier in the week from a vol perspective when we had the mini announcements coming out, and now we have the actual earnings announcement. So from a vol trading perspective, it was kind of strange because you weren't allowed to really have the pronounced implied sell-off that you might have had usually after something like a mini iPad announcement earlier this week, because you have earnings 2 days later. So things have been somewhat artificially inflated still, I think, than they would have been otherwise. But now we'll all learn after hours exactly what is in store for everyone's favorite fruit company. And Mr. Sebastian, what are you looking at in the land of... Actually, before we even get into the VIX, you were talking about earlier on the show about Apple calendars. I know you tend to like to lean on the long calendar side of the equation. Is that what you're leaning here to? Long Jan, short Dece, you're thinking for Apple?
The Ox straddle... Here's the whole thing, Mark. The Ox 610 straddle with Apple trading around 612, so that expires tomorrow, is less than $33. So that's under a 5% move. And Don, I know this is blasphemous, but if you look at where premiums have been priced this season, as a whole, especially on big names, they've been very, very underpriced.
Are you going to say buy the weekly straddle with 2 days to go? I think Don might shoot you if you say that.
Let's just put it this way. If someone put a gun to my head and said buy or sell the 610 straddle, I would buy.
Are you allowed to say don't sell it?
It's absolutely, to put it Don's way, I would absolutely not sell.
There you go.
That October straddle. It is
Let's go with that.
Especially once you've seen Google and Facebook and IBM and Microsoft and Intel, all the big tech names are outperforming their straddles. You can't really make an argument to go anything but long. The calendar that I would look at might be like the December 6.25, Jan 6.25 time spread. The one thing I'll say about Apple is I think sentiment's so bad. The fact, Tucson's out of it now. That shows you how bad sentiment is.
That is huge.
Which makes me want to, and I know this, and it's nothing against Tucson. It's not that I think he's done, but, if his clients, the retail public, are now out of it, that means it's now ready to go up again.
I don't know. So, maybe the mini finally broke the back of the retail. They said, wait a minute, this is one too many ridiculous things.
Anna, my assistant, says it fits in her clutch, so she's going to buy one.
Well, there you go. That perhaps explains the 30-odd handle sell-off the names had post mini announcement. People, the street, not exactly loving that mini. But before we go here, Mr. Sebastian, looking at the S&P 500, which is your want? What are you thinking here from a VIX perspective for the coming week?
The back end of the curve is really, really overpriced. We're at about 18%. We've had two big moves in volatility. Now, we still haven't moved 2%, but we've had two relatively decent-sized moves. So realized vol is ticking up, but is still a huge premium. If you look, we've had these huge up days the last couple of days, and so 10-day vol is now almost 14%. And 30-day vol is now, 30-day and 20-day are now almost 12%. So what I envision happening is what seems to be happening. A small uptick, or at least maybe we hold steady here with realized, and then that spread's probably a little wide. So I would expect VIX maybe to kind of creep back towards 17%.
Yeah,
so
they're crushing it as we speak, and they crushed it a little bit yesterday. So it looks like they're leaning that same way, taking some of that air out of the balloon. Unless the market takes off to the races again, VIX already coming in about 1%, and probably will continue that way if all holds steady.
Yeah, no, I agree. So if we just kind of have this, you'll see stuff fall. I do think that it's interesting that we've had this horrible earnings season, and we've given away less than 4% of the market. So just tells me once all this gets through, I think we're probably going to be right on the rally train again. Too much cheap money.
We'll see what happens tonight, though. Where Apple goes, so goes the public sentiment, it seems. And if they are looking grim, then the public's will may be indeed broken, which, of course, if you're contrarian, could be the buy signal you've been waiting for. Interesting stuff. Thank you, Mark. Thank you, Don. And that is going to do it for the Crystal Ball segment. But of course, before we go, we like to check in with everyone here on the old Vol Views panel to see what's coming up in their respective necks of the woods that may interest our Vol Views listeners. Starting off with you, Don, what is coming up in the land of volex.us?
And just putting exchange of emails with our webmaster and getting the finishing touches on what will be an ability to make available to our readers some of the really tremendous and detailed statistical analysis from the paper that we discussed last week. So look for both the paper itself and some of the data that form the basis for it on the website very shortly. We're just kind of paint is just drying, and we'll get it out there very quickly.
All right, we'll keep an eye out on that. Of course, listeners, if you missed our last show, that's what Don is talking about, the interesting study he and Nick Lee did looking at some interesting ways that you can implement and trade these vol contracts and proposed ways, and actually some surprising results. I think you'll say, Don, I certainly was surprised by the way they performed and how they compared to traditional buy and hold and other ways you might traditionally trade products like these. So interesting stuff. If you're looking for some ideas, this might be a good place to start. And Mr. Sebas, I think I know what you're going to say. You, of course, have the mega day of volatility, I believe you're calling it, over
That's
at
exactly
the CBOE.
right.
That is the official marketing term?
That is right. Now, it's going to be all day using volatility trade direction. We'll talk about if any of what we were discussing in terms of time spreads and different things like that. I would absolutely take this class. It's going to be a can't miss. So
there you go. All day at the CBOE with Mark Sebastian, the guys from the Options Institute, and I believe one or two people from the street as well. So
yep.
quite a potpourri of volatility to discuss.
It's going to be a cornucopia of volatility.
There we go.
I like that. That's a nice phrase.
Yeah.
You're too euphoric. You're too euphoric for my taste today, Mr. Sebastian. I don't know. I don't know who this person is.
I apologize for being so loquacious.
A veritable smorgasbord.
Yes.
Hey,
There we go.
Kid.
Of volatility. All right, and with that lovely picture and image in your head, listeners, that's going to do it for us here on the old Volatility Views show. We, of course, want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. If you've been writing into us, we'll get to you next week. We had a guest, of course, today, and that tends to bump the mailbag, but we'll get back to that segment. We know you guys love it, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.